Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Monday everybody. I wish you all a productive week ahead. Today's video will contain sponsored content. When this is played, it will be clearly labeled as such. China Update presents an average of just 2 sponsored videos of a few minutes each month. It is hoped that this is the least intrusive way of working with sponsors for the viewer experience. It also means that the channel is financially sustainable while also ensuring that it's still primarily supported by subscribers. That is, you, the viewers, rather than corporate sponsors. For details on the channel policy when it comes to working with sponsors, see the description below. And if you like today's video, don't forget to hit the like button. Okay, we start with the economy and specifically the ongoing housing crisis. According to official numbers published over the weekend by the National Bureau of Statistics, housing prices in China dropped at a faster pace in August, once again demonstrating policymakers' many efforts to revive the ailing housing market are failing to bear fruit. Quote, "While the Chinese government has recently strengthened policy support for the property sector, we expect the impact on property sales to be short-lived and differentiated between tiers of cities." End quote. Last week, Moody's cut China's property sector's outlook to negative, saying it expected contracted sales to fall by 5% over the next 6 to 12 months in China. According to the numbers published by the National Bureau of Statistics, new home prices in 70 cities declined 0.29% last month from July, when they fell 0.23%. Property investment and residential sales remained weak. Property values are also slumping in the secondary market. Existing home prices fell 0.48% month on month, the most since 2014. According to Bloomberg calculations based on this and other separate official data, residential sales by value was the weakest monthly level in almost 6 years, up only 2.9% in August from a terrible July. Let's go back to the topic of failed government support policies, which we have been following closely for months now. In an article published over the weekend called "China's Latest Policy Support Boosts Home Sales," but briefly, Chinese financial media outlet Caixin writes that the rebound in China's home sales following the government's recent measures to revive the market appears to have been short-lived, as transactions are now falling back again. Contracted property sales by floor space in 19 large and mid-sized cities, the outlet writes, plunged almost 30% in the week ending September 10th, compared with the previous 7-day period. Although the data cover commercial property as well as residential housing, homes accounted for some 90% of the country's property sales by value in the first 7 months of this year. Thus, these trends are fairly representative of residential trends. As we have seen in previous videos, increasingly desperate localities, including Tier 1 cities which traditionally never had issues with demand, are rolling out incentives and rolling back restrictions in order to save their local housing markets. It also appears that some parts of the system do not want to play ball. China's powerful and already squeezed banking sector appears to be shunning a 200 billion RMB, $27 billion facility to provide interest-free loans to 6 state-owned commercial banks to finance thousands of stalled property projects across the country, which the People's Bank of China announced in November of last year. UK-based The Financial Times reports that, quote, "But almost a year after the program was launched, less than 1% of the funds have been distributed to banks which were supposed to match the People's Bank of China loans with their own lending, but have been unwilling to issue further debt to the ailing sector." End quote. One significant hurdle, the outlet writes, has been finding suitable recipients for the funds. Many developers could struggle to generate cash from unfinished projects to repay loans as their properties are pre-sold or have already been pledged to existing creditors. An official at the China Development Bank reportedly told the outlet, quote, "This bailout fund project is set to fail due to a lack of sources of debt repayment." End quote. Next up for the economy, one more brief update. The People's Bank of China, China's central bank, continues to increase its gold reserves. China's official gold reserves rose to 69.62 million ounces as at the end of August, up from 68.69 million ounces a month earlier, marking the 10th consecutive month of increase. In those 10 months, China's gold holdings were up 11%. Professor Michael Pettis of Peking University observed on the news, quote, "This implies that the value of gold now accounts for roughly 4% of China's official reserves, 3% if we include hidden reserves. On average, gold represents 17% of official reserves for advanced economies and 7% for developing economies." End quote. Indeed, central banks all around the world are increasing their reserves of gold, as are many investors. During times of geopolitical uncertainty, like what we are living through right now, the smart money turns to adding gold, or firms in the gold sector, to their portfolios. And today's video sponsor, West Red Lake Gold Mines Limited, WRLGF, is providing an excellent opportunity for investors to do just that. West Red Lake Gold Mines Limited is a mineral exploration company focused on advancing and developing its flagship Madsen gold mine in the Red Lake Gold District of Ontario, Canada. There are three factors that makes West Red Lake Gold Mines stand out as an attractive pick. First, the management and the investors already behind it. A major shareholder of the company is none other than self-made mining tycoon billionaire Frank Questra, who was instrumental in co-founding Goldcorp and making it the largest gold miner in the world by 2011, as well as a series of other incredible gold mining companies. He is arguably the best in the business. What Frank does is look for poorly managed existing projects with all the infrastructure in place, take it over, and put a good management team in to grow the project rapidly. That is exactly what he has done with this company. The president and CEO of West Red Lake Gold is Shane Williams, who was the chief operating officer for Canadian mining exploration company Skinner, that in February 2019 traded for $1 a share, and then by 2022 traded for $16 a share. This man knows how to evaluate and take mining projects forward. The board of directors is also very strong, with several legends in the industry. Second, the location. Red Lake Gold District of Northwest Ontario is one of the richest gold mining regions in Canada. The company's business plan is to stabilize the maintenance cost of the mine and mill effectively, finish the drilling work that needs to be done to fully understand the geology, develop the mine to production, which is only 18 months away now, and then begin to use the leverage of the cash flow to build a big mining operation. This is exactly the model that Goldcorp deployed in the 2000s. And this leads us to the third factor, the current market price. Once operational, West Red Gold Mines is looking to produce about 100,000 ounces per year of gold. And this is just initially. Companies with similar production capacities trade for north of $500 million market caps. The previous owner, who mismanaged the company during the COVID-19 lockdowns, reached a market cap of $1 billion. The current market cap for West Red Lake Gold Mines is only $60 million. This is where the opportunity is. If this project is successful, then the company value will skyrocket as the market reprices it. This is a speculation of sorts, some risk for sure, but also the real possibility of very high returns. With the right investors and management, the right location, the right business plan, and a low market cap with room to grow, West Red Lake Gold Mines Limited is definitely a pick worth looking into. We remember that all investment involves risk. This is not individual investment advice. Always speak to an investment professional before making any investment decision. Once again, a big thank you to West Red Lake Gold Mines Limited for sponsoring this episode of China Update. Okay, we are now returning to regular content. Next up, we look at an often overlooked but very powerful vested interest in China, Big Tobacco. Quote, "The PRC government has made huge progress in reducing air pollution over the last decade, at significant cost to some industries, but it has so far been unwilling to tackle the state tobacco monopoly." End quote. The massive state-run China National Tobacco Corp, with its 19 regional tobacco subsidiaries controlling 96% of the Chinese market, has long provided lucrative revenues for the government. Indeed, in 2022, profits and taxes from the companies generated 1.44 trillion yuan, $213 billion for China's central government. Recently, Germany-based Der Spiegel and investigative newsroom Paper Trail Media, Chinese language outlet Interim Media, and Austria's Der Standard published a jointly reported project about the PRC and its failed commitments to an international tobacco control treaty it signed almost 2 decades ago. The piece is called "How China Became Addicted to Its Tobacco Monopoly" by outlet The Examination. We end today's video by examining several salient points made in the piece, which gives us a rare look into how powerful vested interests can frustrate Beijing's policy objectives. We are now quoting selected excerpts directly. China has about 1/5 of the world's population and buys about half of the world's cigarettes. 2.459 trillion. That's how many cigarettes were sold in China last year, more than in the next 67 countries combined. Epidemiologists say smoking-related deaths will soar in coming years, straining the country's health system. Given China's spectacular economic success, the piece asks, why has it failed to tackle its tobacco epidemic? Quote, "For 2 decades, China Tobacco has undermined a landmark anti-smoking treaty. Millions more deaths are predicted as a result. Under the treaty, the World Health Organization Framework Convention on Tobacco Control, China pledged to enact a national indoor smoking ban, a measure that both protects people from secondhand smoke and, researchers say, makes smoking less socially acceptable. But in China, the national law never happened, and efforts by municipalities to implement their own bans have been challenged at every turn by the tobacco monopoly, commonly known as China Tobacco. China Tobacco can do this because it is a spectacular money machine. In 2022, profits and taxes from the company generated 1.44 trillion yuan for China's central government. That figure is about 7% of government revenue and nearly equivalent to China's $214 billion, $1.45 trillion yuan defense budget. It's a comparison that leads some in China to joke that they are helping the government build warships when they light up a cigarette. The company is also a piggy bank for the priorities of both China's central and local governments. China Tobacco is a major contributor to the government's $45 billion microchip development initiative, known as the Big Fund, and it has aided President Xi's Belt and Road Initiative. As of 2017, when one of its investment subsidiaries helped another state-owned entity purchase a major bank in Kazakhstan. China is hardly the only country to struggle to reconcile the economic might of its tobacco industry with the health harms of cigarettes. Still, China's struggles do stand out. Between 2000 and 2020, the global adult tobacco use rate fell from 34% to 23%. In China, it only declined from 27% to 26%. End quote. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a wonderful Monday, have a good and productive week ahead, and I will see you all tomorrow.